Thank you for joining. I'm Kirsten Wegner. I'm CEO of Modern Markets Initiative. We have had a series of really interesting brown bag lunches while many of you are working remotely to keep conversations going on market structure. And today we are so delighted to have Ananth Madhavan along from BlackRock. He's a managing director who is here to talk with us today about the state of the ETF industry. Ananth, thank you so much for joining. I know in addition to BlackRock, you wear a lot of hats. You, in addition to being an avid biker, I know you're on the FinSAC, so you're meeting quarterly with the SEC. You're also a professor on innovation at Berkeley. So thank you for joining us today. I guess my first question is, we've seen a huge growth in ETF industry and participation, and this has really been a positive trend for investors. Can you explain about this positive trend? What is an ETF to those who may be joining who just want to learn more about it? And then we'll go deeper into some of the issues here.
Great. Well, Kirsten, thank you very much for inviting me to speak today. It's a great pleasure. And, I've watched some of the past shows with Jim Angel and others, so it's great to see you. Okay, so let me take your last question first, which is what is an ETF? So an ETF is actually it's a very simple thing. It's basically a basket of securities that could be stocks or bonds. And this basket trades intraday on an organized exchange like ARCA or NYC, so it trades in a very transparent manner with firm bid offer quotations. Why has it been so popular? I think one couple of numbers to keep in mind. I mean, one is that the first US ETF was only launched in 1993, and that was the SPY Spider. Since then, we've had a proliferation of funds. Another stat to keep in mind is that roughly about a decade ago, it was less than $1 trillion in ETF assets. Today, it's in the US, and today in the US, it's over $4 trillion. And roughly $6 trillion globally. So there's been tremendous growth. And taking now your first question, what's powering that growth? The ETF has natural advantages for investors of all types. So there are retail investors, there are institutional investors, hedge funds who are buying these ETFs. And they find it a very convenient and cheap way to gain exposure to broad asset classes or themes or sectors. Such as utilities or energy or something like that. And so the advantages of ETFs are that they are transparent. So every day, typically, the holdings are disclosed. They're quite cheap relative to buying the underlying assets. That's particularly true of bond ETFs. They're diversified exposures. And they also offer tax advantages, because of the structure. So those are a lot of the reasons for the growth and proliferation of ETF assets.
And a question for you. I mean, over the past couple of months, we've seen a lot of volatility in the markets, and before ETFs hadn't really been tested yet in periods of great volatility. What is the data that you've collected, your body kind of research show as far as how ETFs have performed during periods of volatility, including the past several weeks and months?
Yeah, it's a great question. I mean, I should point out that, you mentioned FinSAC, and as part of that, I was chairing a subcommittee on bond ETFs and mutual funds. And we produced a report on stressed markets, this was over a year ago, where we did document that, ETFs had actually held up quite well in times of market stress, such as the taper tantrum and even the financial crisis of a decade ago. But we did also caution correctly that we hadn't seen extreme volatility in the last decade. It's been relatively muted. And, a decade ago when we did have the financial crisis, there were many fewer ETFs, particularly bond ETFs. What we've seen since then is extreme market volatility in March and April, particularly in March. And ETFs largely held up. I think there were a couple of instances of levered funds that were closed, but I want to caution that those were not really what we call true ETFs. Those are not plain vanilla ETFs that just hold bonds or stocks. They had some embedded leverage in them, and in many cases these are exchange traded notes, which are unsecured debt obligations. So the traditional ETFs actually held up really well. They traded during the day with relatively tight bid-offer spreads compared to the underlying stocks or bonds. And investors were able to take off or gain exposure quite easily.
And can you talk a little bit more about this investor impact? We know that ETFs have helped investors transfer risk in difficult market conditions. Can you kind of elaborate on that? Because that is a positive trend, I think, to highlight to people.
Yeah, I mean, so many investors, I think, in the crisis, they either wanted to change their allocations to stocks or to bonds, so maybe they felt there were certain sectors like energy that were undervalued. ETFs offer a really convenient and easy way to gain access to those exposures or to take off unwanted risk. I think the key thing with ETF liquidity to understand is that in the press, you see lots of statistics about high ETF volumes of 30, 40% of daily dollar volumes in the securities markets. Most of that is actually netting off. So for example, if I sell you an ETF, let's say I'm spooked by the crisis and I sell my equity ETF to you, that doesn't necessarily mean that there's going to be a trade in the underlying stocks or bonds. All that's happening is that we're exchanging ownership of the fund. So, I was an owner, I'm no longer an owner, you're now an owner. We don't necessarily have to trade the underlying securities. So those high volumes that we see are actually in the secondary market are actually a safety valve of sorts.
Right.
People are bullish, people are bearish, people want to alter their exposures naturally given the global pandemic. The ETF offers that safety valve of allowing people to adjust their positions, their exposures, without necessarily having to transact in the underlying securities themselves and bear costs.
And I think that's an important distinction to make, but it is interesting. It seems like there was enough liquidity to help power all that rebalancing and the transfer of the ETFs, that the market conditions, I think, allowed the markets to continue to function quite well. So that was an interesting takeaway. I saw that some data you guys released from the week of March 9th that the ETF trading volume surged to a record $1.4 trillion in a week. That's a pretty high number. But I think you had just some positive kind of feedback to share from that with that huge volume that the markets were still, functioning well.
Yeah, no, it's true. I mean, the markets functioned extremely well. Another data point for you is, in that critical week of March 23rd to 27, when the volatility was really at all-time highs, the high yield bond ETF that we have which has often been picked on by the press as saying, oh, there's some problem if you've got a high yield bond ETF and yet the underlying bonds trade very infrequently. That bond ETF traded over 160,000 times a day in that week. 160,000 transactions a day on average. The actual bonds in the fund, the top 5 bonds, traded only 25 times a day. So the ETF was really where the market was, and as I said, tremendous liquidity and tremendous price discovery, because that's where buyers and sellers are actually interacting, on an organized exchange and agreeing on the price of the bond fund.
And that's an interesting point too, because typically, people had speculated in the past that where there would be high volatility, there'd be a drying up of liquidity, and that actually, in fact, did not happen. So we saw the market intermediaries, the automated traders, continue to trade to provide that liquidity for the ETFs. So it was interesting. We had such a huge volume of trading happening with all this volatility, and yet there was still enough liquidity. So you did not see any sort of drying up of liquidity over the past few weeks.
No, that's exactly right. I mean, the market participants in the ETF ecosystem include not only the authorized participants, who are the entities that can create or redeem shares, but also market makers and liquidity providers like high-frequency traders.
Right.
All of them were participating and providing that secondary market liquidity, which, as I said earlier, is this form of a safety valve.
Right.
So it doesn't, that those transactions don't have large effects on the underlying stocks or bonds. Obviously, there were challenges. So the bond market in particular is opaque. It is characterized by lack of transparency, relatively illiquid in certain parts, and typically transactions are with dealers, difficult to actually obtain liquidity, obtain firm prices. So we had challenges in the underlying bonds, but the bond portfolios, the ETFs, actually were quite liquid. And the reason is in terms of financial economics, if you think about a bond portfolio, it's much easier to hedge a portfolio of stocks or bonds than it is to hedge individual securities. So that's one reason the transaction costs were so much lower. The second reason is asymmetric information. So obviously, if I come to you, if you're a market maker and I come to you and I want to sell a lot of one particular stock, you may suspect I know something, and that's the asymmetric information. If I'm selling the S&P 500, it's very unlikely I have some private information about the value of the entire stock market. So for both of those reasons, the bond portfolios trade in a very, bond and stock portfolios traded quite tightly. Obviously, spreads were larger than normal, but they were still quite tight relative to where the individual stocks and bonds were trading.
And some of the BlackRock data I also wanted to highlight. I read literature of yours about the bid-ask spreads on some of the ETFs being even narrower and tighter than some of the underlying security bid-ask spreads. And I think that's really interesting, especially for any retail investors who might be listening, because people do ask things about what is the difference between an ETF and trading in a stock? How could they be more efficient, perhaps, than investing in underlying stocks alone, or limit risk exposure? But that was a surprise. Was that a surprise to you that the spread would be tighter on the ETF than the underlying security in some instances, or was that something you expected to see?
Well, you raise a really good point, because I hear this all the time, and in fact, there's a term for it that sometimes people use called liquidity mismatch, and they sort of refer back to the financial crisis. Sometimes they say, well, there's something funny going on. The underlying bonds, trade with bid offer spreads of 50 basis points, 30 basis points, and yet the ETF is trading with 1 basis point, 2 basis point spreads. How is this possible? There's some alchemy going on. There's some financial engineering going on. And the answer is actually what I said earlier, which is it's quite natural for a portfolio to be more liquid than individual securities, because it's easier to hedge and because there's less asymmetric information. Those are solid reasons why we would expect the spreads to be tight in these securities. And in fact, that is exactly right for individual investors who are looking for exposure and concerned about trading costs. The ETFs offer typically a very good way to gain exposure and even take off that exposure. I think the other point I want to make is just when you think about the ETF as just a basket of stocks or bonds, when you think about it, it must be more liquid than the underlying basket, because it's always going to be added. And the reason for that is, if the ETF offers nothing in the way of additional liquidity, if there's no additional liquidity, the ETF spreads are going to be basically the average spreads of the underlying securities. But if there's additional liquidity, then the ETF spreads are going to be tighter. So the ETF there's always this incremental liquidity, because the basket can be traded separately without necessarily trading the underlying component stocks or bonds.
What do you see as some of the trends looking ahead in the ETF industry in the next months or years?
Oh, another great question. Okay. What we've seen is a huge uptick in fixed income ETFs. So the fixed income market is very ripe for innovation and ripe for transformation. ETF assets are less, roughly about 1% of total bond holdings. So there's a huge upside to that. And again, the advantages for investors who are looking for broad, diverse fixed income exposure of an ETF is that you don't have to trade the individual bonds. And I alluded earlier to some of the challenges of trading individual bonds particularly for retail investors. So the bond ETFs offer diversification and low cost ways to gain exposure. The other trend we've seen is in what's called smart beta. So these are bets on factors such as quality or value or momentum. And a lot of academic research over the past few decades has shown that these factors are typically associated with risk premia. They offer an alternative way of gaining, some sort of additional return over and above sort of the market. So factor exposures and smart beta is another theme. Finally, I think there's a lot of interest in thematic exposures, so and particularly around ESG, so environmental, social, governance factors. So many investors, particularly younger investors, are focused on these concerns, and they want to invest in companies that match their outlook and are concerned about the environment, or and they don't want to support certain kinds of industries or certain kinds of firms. And so we've seen a lot of uptick in ESG type of investing. So those are the factors that I think are really driving a lot of the ETF growth in coming
And when
years.
you look at ESG investing, that's a really interesting topic. It's something people always ask me about, both on the Hill and just general public members. Do you see that as something that both institutional investors are desiring as well as individual investors? Is that something you're hearing perhaps pension funds ask for? Is there any, I know there's always a debate between ESG and then the actual, returns, and if there's one at the expense of the other. What is your insight into that kind of discussion, and what topics should people be looking for as they look at the ESG?
Well, so I think it's you raise a great question. So the interest is broad based. I mean, so obviously retail investors, are increasingly concerned about ESG considerations, and it's important for them. But we've seen also a huge uptick in institutional interest in ESG. Many pension funds, sovereign wealth funds, and so on have explicit guidelines now to take ESG into consideration in their investment decisions, and so they're actually obligated to do that. And so we're seeing a lot of interest in that. Now, of course, there is no one size fits all. So certain funds may care about alcohol and tobacco, for example. Others may care more about exotic weapons or controversial weapons. So there is no one size fits all, which is what makes it challenging. What's our research showing? So now getting back to your second question, is there a trade-off? Do you have to sacrifice returns? We've actually done a lot of research on this quite recently, and what we found is actually very interesting that ESG characteristics, when funds load up on ESG characteristics, there actually are benefits in the form of higher returns and lower risk. Some of that comes about actually because of ESG considerations that actually go back to the factor tilts that I was mentioning earlier. So when a fund loads on companies that have high ESG scores by whatever metric, they actually tend to have factor or smart beta tilts that come about as a consequence. So in particular, companies that are higher quality in the form of more stable earnings, companies that have good workplace characteristics, good governance, tend out also to be companies that are higher quality, and quality is a rewarded factor. We've seen in the past decade. So there's a factor tilt that induces higher returns, and then at the same time, those same characteristics may reduce the tail risk. It's companies that are well governed, that have stable employees, treat their employees well, less likely to suffer from strikes or accounting fraud, those types of considerations. So there's both a return and a risk element to it. And I think what we've seen in the COVID crisis particularly is ESG did very well, and BlackRock has published a report on this. Our BlackRock Sustainability Institute has published a very comprehensive report on the behavior of ESG funds in the crisis, and we saw that it was really borne out that these funds actually did quite well relative to broader market indices. And is that report something that viewers could find on the BlackRock website, or that we could maybe post on our social media site afterwards? I think that would be interesting. I think it's there, and it got a fair amount of press when we released it. So
great. I think those arguments we've made, just discussing good governance and ESGs, yielding a higher rate of return just because of the corporate structure. I've heard that argument made also about diverse boards, and more women on boards yielding certain results, or correlations at least.
Yeah.
Are you guys doing any research on boardroom diversity at BlackRock? Or I think
as I said, we have a whole institute and a large group of people doing really advanced and great work in this area, and including on board diversity. And I think we saw that in the COVID crisis too, where the countries that actually did really well were run by women leaders. And so, I think there's a lot to be said for, the board diversity and the idea that people who are thinking differently and avoiding groupthink make better decisions. And I think that's a theme of some of our research that BlackRock has been publishing on.
And I think I wanted to ask you, this is a frequent discussion topic over whether it's more efficient for investors to, invest through passive investment strategies like ETFs or through kind of active managers. I think this could probably be debated forever because each side probably has written their own books. But what are your key thoughts on ETFs versus individual stock investment or active management, and net effect for investors as far as cost savings perhaps?
Yeah, no, you're right. It's been debated forever. I think this dichotomy between sort of active and passive is sort of somewhat of a 20th century construct, if you will. I think at one point in time it was useful when Jack Bogle was trying to launch the Vanguard Index 500 fund and was touting its benefits. I would say that actually the way we think about it at BlackRock is that all investment decisions, including investment decisions into ETFs, are active decisions. So, so when I was starting off investing, I did buy the first ever ETF, and at the time the S&P 500 was at 450. It's like at 3,100 something now, and I still have those positions. At the time, I thought I was just buying the market. I thought it was actually an index decision, but in retrospect, it's actually a very active decision. It is US only, it is large cap, tends to be loading on quality and less on some of the value aspects of things. So there are those embedded factor bets in that decision. So I would say that all investment decisions have that active quality to them. And what we've actually seen is many active investors, hedge funds and others are actually using ETFs. And so they're using these tools as building blocks to gain exposures, to explore themes. It's so I think that the construct that we now have is that there's really a range of things, and there's always going to be room in our minds for successful active management, because people, if they can get the exposures they want, the building blocks, they want broad exposure to U.S. Equities or broad exposure to international equities, they can do that very easily through low-cost ETFs, and those cost savings compound through time. At the same time, if you want genuine alpha, if you can actually sort of focus on the search for managers who can deliver pure alpha, then you can have the best of both outcomes. You don't have to pay up for broad exposure because you can gain that very cheaply and very easily. But at the same time, you can search for active managers who will deliver value in certain sections of the market.
I think that's a really good point you make about how the kind of false distinction between active manager versus non-active manager, that the active investing in ETF is already an active choice. I think that's really interesting. And it brings to mind, automated trading and high frequency trading. Pretty much many industries, that technology is being broadened out now, that many people are in a way automated traders as well, using rapid technology. And even everyday investors now could trade on their iPad for zero cost investing through very sophisticated technology. So it is just interesting to see how the market has evolved, in a positive way for investors. I guess the last question I really wanted to talk with you about is, or the last issue is, the elections are obviously coming up. This has been a very tumultuous year so far with a lot of volatility, a lot of wounds the country is healing right now. And the elections are just 6 months away. And one of the topics people are continuing to discuss is the financial transaction tax. I think personally, this shouldn't be branded as a Democrat or Republican idea, but to the extent people are talking about a financial transaction tax, what are your thoughts on such a proposal as it would relate to just Main Street investors? Would this be a positive or a negative for Main Street?
Yeah, so MMI is published on this topic, and I would say that in general, my feeling is that financial transaction tax might have a lot of unintended consequences. So there's a natural tendency, I think, for people to say, well, for an index investor, be it through a mutual fund or through an ETF, they've got long horizons, and so a small tax doesn't really matter to those investors. But I think the reality is that, particularly for ETFs, I mean, we're very dependent on secondary market liquidity, and we look to liquidity providers broadly defined to provide that liquidity, which you saw during the COVID crisis, and that's very important. And for them, these relatively sort of seemingly small transaction taxes could quickly add up, and I think that might affect the secondary market liquidity that is so important for individual investors who are relying upon that. So I think those are the questions that I think when we look at this from a data viewpoint, those are the questions to ask of empirically what would be the impact of a cost on bid-offer spreads via the mechanism of increasing costs for liquidity providers broadly defined. And I do share some of those concerns that might have unintended consequences and impair liquidity and raise costs for individual investors.
Well, that's a really interesting, and useful takeaway because I think you're right. As there is a tax on each transaction, the liquidity will decrease and the spreads will certainly widen. So we'll be, MMI will be sharing our data on that proposal. And we'll be happy to share that information with the audience as well. Well, last, I guess, Ananth, we just have a couple more minutes. Are there any other last takeaways you'd like to share with viewers, or just a key, I always finish with a key message you want to give to just ordinary savers who are saving for retirement or college as it relates to ETFs? What would your last message be for them?
Okay, well, I would just say that I think it's very important to understand what you own. That's the main thing. So the term ETF is used very broadly in the industry, but it also applies, I think, to the term is used, unfortunately, for things that really aren't pure ETFs. They have embedded leverage in them, or they are unsecured notes. And so I'd say that the ETF ecosystem and the ETF opportunities are very large for investors. There's a lot out there, but the caution, it's an old caution, but it's always, know what you own. So to read the fine print, read the prospectus, understand that there's no free lunch, understand that some of the more exotic products can go to zero and can be shut down. And I would say that, in general, there's a lot of opportunity, but, again, the key things are diversification, low cost, and as I said, knowing what you own. That's the bottom line.
That's great. All right. Well, you heard it from Ananth. Know what you own with ETFs. Thank you, Ananth, for coming on. We really appreciate it. And we will be posting a copy of this and any data that's been cited at Modern Markets on Twitter and also on our website at modernmarkets.org. So thank you, Ananth, for joining us, and I hope you get a chance to go bike riding later. Everyone have a great rest of your day. Thank you.
Thank you very much, Kirsten. It's a great pleasure. Okay, thanks. Bye-bye.